Rob, I'm going to switch to English so you can hear me, but I promise you I'll get you to present at one of my conferences or one of the events. And I'm really glad that it worked out timing wise. And I'm glad that you're able to join us here today for our closing keynote. And it's great to have you on. And I see you adjusting the camera. That's fantastic. And I think we're good to go. You're starting to share the screen. We're going to hear from you, and I hope we have some time at the end for a couple of questions as well.
All right. Good, Kai. Thank you very much for the invitation. Delighted to be here. I'll start off by saying I'm a contrarian investor and a company builder who seeks opportunities in distressed and overlooked situations, because that's where I've made my biggest gains. 75% of my wealth is invested in gold bullion, shares of exploration companies, and a gold and silver company that bears my name. And I do that because I strongly believe that these investments are going much higher. I'm a contrarian investor, a company builder, and I look for opportunities in distressed and overlooked situations, because that's where I've achieved the largest gains in my investing. And 75% of my wealth is concentrated in gold bullion, shares of exploration companies, and in McEwen mining, because I believe these are going much higher. Over the last 11 years, gold's performed very well in all the major currencies, as you can see in this graph. It has served the purpose of protecting the purchasing power of your capital. Now, I'm not going to go into gold as much as Ronnie would have at the beginning of yesterday, as he's an excellent spokesperson for the gold market. But there are a few slides that I think are important. If you look at gold, it's often been viewed as a contrarian and investor's place. But year to date, gold has outperformed all the major stock exchange indices in the world. If you look at some of the billionaires out there who are buying, you can see Paul Tudor Jones. He's got a net worth of just under 6 billion. He manages 38 million. He called the crash of 1987, but his favorite trade over the next 12 to 24 months is gold, and he has a target of $2,400 to $6,700. You then go down to Ray Dalio. He has a net worth of $17 billion. He manages the largest hedge fund in the world and has 136 billion under administration. And he's been advocating for some time that portfolios have 5 to 10% weighting in gold. Warren Buffett, with a net worth of $78 billion, recently stunned the market when his company, Berkshire Hathaway, bought gold shares for the very first time. And then we have Eric Sprott, who's one of the most active and successful investors in the gold and silver space. And he believes that right now, gold and silver equities are the investment of a lifetime. What I think is going to drive gold in a way that we haven't seen before is the social media. And this graph is just showing the searches on Google for gold. And you can see over on the right-hand side, there's been a big spike in searches. And these social media outlets are definitely fueling the market in the tech stocks. And I think once they start embracing gold, we're going to see it fly. So why gold? Why now? It's a safe refuge. And from what? And you can see on this table a number of reasons: interest rate, debt loads, monetary expansion, a long-running bull market, geopolitical tensions, and COVID response are all contributing reasons why you should be buying gold. Another thing you should be looking at is just low and negative interest rates. They're unsustainable. Anybody looking at this graph knows that over this 45-year period, actually 65-year period, interest rates, the average is not zero. And it's unlikely that we're going to see zero stay there forever, but it's giving a false sense of security in the marketplace. Politicians have created this situation of low interest rates, and it's going to jeopardize the savings of millions of people, their pension plans, their insurance policies, and their retirement. Right now, negative interest rate yielding bonds amount to about $17 trillion, or 25% of the global market for bonds. You can see that when debt levels rise, and in this case, up to 130% of GDP, there have been a number of companies that have defaulted on their debt. And right now, the United States, and I suspect a number of other nations, are approaching this dangerous point of no return with their debt. Governments worldwide have dramatically increased their debt loads, largely in response recently to battling COVID. But to give you a sense of the magnitude of this increase in debt, during the 4 months between mid-March and mid-July, the American government's financial response to COVID was 20 times larger than what they used in the 18 months in 2008, 2009 to handle the global financial crisis. We also are looking at explosive monetary growth, again, around the world. And some of these curves are starting to approach exponential rates of increase. This is something that's quite worrying. It's a sign that we may be approaching a period of hyperinflation, but not on a national scale as it's happened in the past, but on a global scale. And this is something the world has never seen before. So besides looking at gold, and you should be looking at commodities, because I think they're going to have a good run as well. So the low interest rates, the bloated debt levels, the central banks putting their printing presses on steroids has fueled a booming stock and real estate values. In the United States, and the financial assets relative to disposable income are at the highest levels in 50 years. And on this chart, you can see these gray vertical bars that indicate the 7 recessions that occurred. Thank you. The bull market we're in has been one of the longest, and we should be expecting a correction. If you don't expect a correction, I want to recommend a book to you. And it's called Extraordinary Popular Delusions and the Madness of Crowds by Charles Mackay. It's a great study of crowd psychology. I think it's very relevant today, and it covers history's most infamous speculative bubbles. The lesson that comes out of the book is that neither wealth nor education provides sufficient protection from the madness of the crowds. So I want to move from gold and look at gold shares and use the GDX ETF as a proxy for the senior gold shares. And you can see on the right-hand side that the GDX performance over the last 3 years is right at the top, beating the NASDAQ, beating gold, silver, the S&P 500, the Dow, and the DAX. Now, there are a number of ways of playing gold equities, and they have different levels of risk. And you can go from the bottom, you get into the foundation is gold bullion, but then you're into the streaming companies and royalties, which I think have done a terrible disservice to the mining industry in general, but that's another point. Then you go to the seniors, the intermediates, the juniors, and the explorers and turnaround situations. And it's at the top of this pyramid where I invest my money, and at the bottom. And I find that a very good mix. So I want to give you an example of some of the companies that I've invested in, junior companies that I've invested in, and they were largely ignored, with the exception of Abitibi Royalties, but largely ignored up until 2 years ago. And you can see the types of performance that these companies have generated And some of these are on the bottom level are as recent as the past 3 to 8 months. Strong moves illustrating the incredible potential of these ignored exploration companies. I should point out that Great Bear represents the 4th major gold rush in the Red Lake District. When I was building Goldcorp, we started the 3rd major gold rush there, but 2 others had appeared, one right after World War II and another one in the 20s. So it's important to be looking again around the head frames and in old mining camps for new insights into deposits. So I'm going to move into talking about McEwen mining for a while and Goldcorp. But I want to give a cautionary statement. The executive summary is, if you're risk adverse, don't buy our shares. Past performance is an unreliable predictor of the future, and unexpected events do happen and will change forecasts. So let's look at Goldcorp for a moment. In the last 13 years I ran it, we had a compound annual growth rate in our share price of 31%. We outperformed pretty much the whole gold market, intermediate and senior gold producers. And we also outperformed IBM, Berkshire Hathaway, Microsoft, the S&P, and the Dow. It was a great story. So McEwen Mining, I'll just first talk about how I got involved in this. So I want to tell you about the gold and silver company that over the past 3 years has significantly underperformed the market and severely disappointed its shareholders. And I must disclose, I have a very large investment in this company, and I believe it's an attractive turnaround story. This company carries my name, and the reasons for the price decline were numerous. Some were non-recurring in nature, others were related to operational issues, and others were financial. I want you to know that these matters are being methodically dealt with and resolved. If you consider buying McEwen Mining shares, you should know that at today's price, you'll be buying it below my cost. So, with that said, let me tell you a bit more about myself. My introduction to gold happened when I was a teenager. My father owned a stock brokerage firm in Toronto, and he put all his clients into gold bullion and gold mining shares in the mid-60s when gold was $35 an ounce. Gold monetary policies, the key role of gold in one's portfolio were frequent discussions around the dining room table. In the summer following my first year university, I had my first introduction to mining when I worked in an underground nickel mine in Northern Ontario. My undergraduate degree is in economics. My master's degree is in finance and marketing. I followed my father into the investment industry and focused on investments in gold and gold mining shares and exploration companies, doing research, sales, fund management, and investment banking. In 1989, I took a closed-end fund and entered a hostile takeover battle and won control of several gold mining companies. I stepped in as the CEO of the mining companies, and over the next 8 years, I led 3 corporate restructurings that resulted in the consolidation of 5 companies into the Goldcorp. The key asset of Goldcorp was its very rich, very profitable Red Lake mine. However, when I bought control of this mine, it was a small, high-cost mine with a very short life and a history of very difficult labor relations. In addition, it had $50 million worth of debt. But right next door was a very rich mine that had benefited from a large exploration program and significant capital expansion during the past 15 years, while the mine I bought had been starved of capital and had little exploration done. I saw this as a distressed situation with plenty of exploration upside. I should tell you that not everyone shared that opinion. It took us 4 years to retire the debt, and during that time, half of my board of directors wanted me to sell the mine, as they saw it as an albatross around my neck. But when we retired the debt, we embarked on an aggressive exploration program, and within a short period of time, we found 1.5 kilometers below surface, a very rich ore body that was located where the experts thought it wasn't to be found. This investment in exploration dramatically changed the value of our company. And after several years of exploration, we outlined a plan to expand the program. We introduced fiber optics, webcams. We put in technology to improve the efficiencies throughout the mine, built a brand new processing plant or mill. And when we reopened the mine, we were producing not 50,000 ounces of gold a year, but 500,000 ounces of gold a year. And our costs dropped from $360 an ounce to $60 an ounce, a 60-fold increase in the economics. And that propelled our share price to generate that compound annual growth rate of 31% that I mentioned earlier. The Goldcorp story was driven by contrary thinking, a heavy investment in exploration, and time to change the way our miners managed. Many in the industry still want to measure their production and cost per ton, but at Goldcorp, we got them to focus on cost per ounce. And you'll hear later that the same strategy is being pushed today at McEwen Mining. Not being received that quickly, but we're pushing it. As Goldcorp's chairman, CEO, and largest individual shareholder, I shaped the company along the lines that I felt would make a very attractive investment. Goldcorp built its treasury to $400 million in cash and gold bullion. It was one of the lowest cost gold producers in the world. It had no debt, and it paid a monthly dividend. But after 19 years of building Goldcorp, I decided it was time to leave. But before leaving, I completed the purchase of Wheaton River and doubled the size of Goldcorp. While running Goldcorp, I built for the company a portfolio of junior mining companies, and the profits made trading these companies was used to reduce Goldcorp's need to raise equity when we rebuilt the Red Lake mine. So I left Goldcorp and became a more active investor in the exploration space. I started buying 10 to 30% of interests in a number of exploration companies. One of those investments that really reinforced my conviction that exploration was where I wanted to focus my investment dollars. This investment grew from my initial investment of $12 million into $180 million in the space of 3 years when I sold it. So in 2005, I bought a company called US Gold. It was a thinly traded company listed on the over-the-counter market in the US. The attraction was its large land holdings, a short distance south and on trend from Barrick's largest gold mine, Cortez Hills. Management wanted out after being there for 20 years. I bought a third interest in the company, and within 7 months, the stock price had climbed from 36 cents to $4.50. At that point, we raised some capital and then immediately launched a simultaneous bid for 4 companies that had properties adjoining our property package. And within a 4-week period, the share price had run up to $10, just under $10 a share. It seemed a little irrational at the time because we hadn't drilled a hole. And you can see this chart where we are. So US gold, which is over on the left-hand side, has some big spikes and troughs, and they were driven by market corrections and discoveries. In 2012, McEwen Mining was formed through the creation of US Gold merging with another company I owned called Minera Andes. This was a strategic move in that Minera Andes had income coming from its gold and silver mine in Argentina, and US Gold had a pipeline of development projects with no capital. So I could see one financing the other. Unfortunately, when we put the McEwen Mining together, it was 2012, and that was the beginning of a 3-year nosedive in the price of gold and the value of gold shares. Coupled with that, the government of Argentina decided to impose a punitive tax on the exports of mineral products. So our revenue dried up. And I'm providing you all this detail because I wanted to share my experiences with you to illustrate what can happen to your investment in junior mining and exploration companies. So let's look at McEwen Mining for a moment. I'll just go back. It's we own 4 sources of gold and silver production. They're located in some of the world's best districts for precious metals. In addition, we have a good pipeline of development projects. So we don't have to make expensive acquisitions to grow. You can see all our operations are in the Americas. I designed McEwen Mining to be different than most junior mining companies, and perhaps most mining companies. I wanted my interests to be very aligned with my shareholders. My salary as CEO is $1. My financial commitment is large. It's $165 million. I am the company's largest shareholder with a 20% interest in the company. And you've heard earlier before, I've enjoyed a successful history of building shareholder value at Goldman. Combine these features with our company's assets. It's listing on 2 major stock exchanges, New York and Toronto, good trading liquidity, and you have a compelling reason to look at the company. Over the past 3 years, gold has done exactly what I expected. And I expect it to climb higher. And I expected our share price would have done the same, but it didn't. And never in my wildest dreams could I have imagined that our share price would have fallen to its current share price. So let me go back in time and put together what went wrong. In 2017, we were building good momentum. In October of that year, we bought the distressed asset I spoke of earlier on in Timmins. We believed and continue to believe it has great exploration potential. And our exploration results are starting to demonstrate that. It included a large property package, a small, short life, high cost gold mine, a mill with excess capacity that would allow for future expansion. And incidentally, it looked very much like Red Lake when I bought it and built Goldcorp. It had an operating mill, as I said, with excess capacity to accommodate future growth. It was located in the famous Timmins Gold District. We bought it for $35 million when the owner had bought it 3 years earlier and had $520 million invested in it. It came with $180 million of tax losses that we'll be able to use to shelter future income. In 2018, we started building a new mine in Nevada, our Gold Bar mine, and it was to be a low-cost cash flow generator for us. Based on our projected cash flow from operations, we decided to borrow $50 million rather than raise equity to fund the completion of the mine. In hindsight, that was the wrong decision, as later events would prove. As 2019 started, our income from Argentina was reduced by the government putting added taxes on mine exports. And that started the shortfall of our projected revenue for the year, and it would grow over time. Late in January, a contractor operated crusher at our Black Fox mine, caught fire, and was damaged and out of commission for 7 weeks. And we had no revenue as a result of that. In March, one half of the same mine was flooded and not accessible for 3 months. Another big revenue hit. At the same time, the startup of our Gold Bar mine in Nevada was delayed. And when it did start running, it was plagued with many operating issues. So operations were higher cost and fewer ounces. Further aggravating the situation was our operations management was unable to deliver on the guidance that they provided each quarter and that we shared with the market. In the end, in 2019, our revenue shortfalls was $70 million below forecast. And we were compelled to make several capital raises at unattractive prices in order to avoid breaching our debt covenants. 2019 ended, but our pain wasn't over yet. In the first quarter of this year, COVID struck, as we all know, and we made the right decision. We closed down our mines to protect our employees' health, that of their families and their communities, but our expenses keep running. And then in the second quarter, we had the misfortune of engaging a firm called SRK that did the geological modeling for our deposit. And they said it was controlled this way. And after a year's production, they came back and said, oh, it's controlled rather than stratigraphically, it's controlled vertically. And as a result, you have fewer tons, fewer ounces in your reserves and resources. That led us to take down an $83 million write down of that asset. So, have I worn you out? There was just one problem after another. Although there seemed to be almost an unending stream of bad news, there was good news last year and in 18. And it came from our exploration program. Those drill results have provided us with the confidence to say that we're going to be mining profitably in Timmins for many years. The big question today is, do you buy it, sell, or watch? We believe the tide has turned for McEwen Mining, and we are in the midst of a turnaround. We've attracted top new operating talent, both head office and at our Timmins and Nevada mines. Our new CEO and new CFO bring a sharper focus on mining and improving the operating margins and pushing the operations to focus on cash per ounce. Regarding our financials, in June, we removed a near-term liquidity issue when we refinanced our debt and pushed the maturity out 2 years to August 2030. In September, we raised $10 million at a 21% premium to our market to continue building on our exploration progress. At our mines, we have been more directed to improve operating efficiencies in order to bring down operating costs and increase our production. At Black Fox, we've taken steps to ensure the fire and the flood are non-recurring. In addition, we've pushed underground development to provide for greater flexibility and grade control. The next growth for Goldcorp has started with the development of the ramp at the Froome deposit, which is scheduled for production in the second half of next year. It's expected to be an easier deposit to mine. Shorter haul distance, larger mining areas, better ground conditions, a more consistent ore body. At Gold Bar, we've done a major remake of senior site management, streamlining the operations, reducing overhead, increasing operational efficiencies with the aid of an operational efficiency experts. This will give you a sense of our strategic growth plan to build production from our various operations between now and 2025. And I just want to take you to look at our relative performance to the GDX from formation in 2012 through to into 2019. We were outperforming the GDX. But subsequent to that, we've been underperforming. And we call this the gap we want to close. And there you can see, upon successfully closing that gap, there's quite a big increase in our share price. So that's our target. We also have a very large copper deposit, and I think we're running out of time. So, hi. Maybe
just a little bit, but it's been interesting. That's why we let it run, and you got to the crux of it, and maybe why McEwen Mining hasn't been performing in terms of share price performance lately, because we had quite a few questions come in. So I let the Q&A or your presentation sort of replace part of the Q&A because you were answering those questions, and that was fantastic. I really appreciate you presenting, and I do have a couple questions, and maybe unrelated to McEwen Mining, but you mentioned your personal investments, and I'm quite interested. Like you mentioned, you're looking for the undervalued stories, and you've invested Great Bear, Abitibi Royalties, Newfound Gold, and I have to admit I forgot the other two from your presentation. But like, what made you choose them? Like, for example, a Great Bear. What did you see?
Well, Goldcorp biggest asset was in Red Lake. When they came in and presented their case, I looked at it and went, some of those grades are looking close to the types of grades and intercepts we saw at Red Lake. They had a large land package, and they had some pretty large spaces between their intercepts, which suggested that there was continuation of the ore. And I mean, it's a prolific camp, and it was quite exciting to see it happen.
I always find it interesting because, like, we've been in the industry, you've been in the industry. Like, how many years is it actually in total?
Wow.
Sorry, I was just thinking. I'm 11 years, and I've tried to compare myself to you. It's like, no.
Well, it's over 30 years in mining and 20 years in the investment industry.
So my point was actually because people always say you got to look at management first. And I remember, for example, Chris Taylor, pretty much before the Great Bear discoveries, wasn't really somebody with track record. He's been around, but his track record came with Great Bear and the huge success, and he's been created there. So how do you bet on a jockey like him with, let's say, a not such clear track record as others maybe?
I look at what people have invested in the company. I look at this setting, and for me, Red Lake was a natural. It's known for its high grade. Its intercepts were bigger than what I saw at Pure Gold, although I own Pure Gold as well. Now I have about 30 companies I have investments in, but it's a collection of things and what you see and where you are in the market. I mean, when Chris came in, the market was pretty weak. They'd increased a bit. And I remember saying, well, I'll take $6 million. And they went, oh, well, could some of our directors get in on this issue? and they upped the price too. But it was one of those situations where either the stock's been pushed down, it wasn't in that case, but it wasn't that hot. It was in the right district, they had the right drill holes, and they sounded like they knew what they were doing.
Interesting. And during your presentation, you sort of mentioned your distaste for royalties and royalty companies. Do you care to elaborate?
Absolutely. I think the royalties and the streamers have taken the profit margin out of the mining companies. They had the money when the equity markets were closed, and they used it to their advantage to buy. And when you look at someone who wants to buy a royalty or streaming company, I think they have large revenues and low expenses. So they're going to pay big dividends. So I think for an investor who's risk adverse but wants to come into the space, that's a great place to be.
So what you're suggesting, actually, let me see if I got this right. Let's say your company sells a royalty to XYZ royalty company. They should actually buy, with the money they're getting from the royalty, they should buy the company's shares just to get the dividends and offset the royalty. Does that make sense?
I think we should see more discipline by management not to sell royalties and streams.
I think we've seen that because of the bear market, I have to admit. And now, because the market is now doing well, we see way too many because now they can finance and they're a little more liquid than the original royalty companies. And it was a great bear market model because companies had to go there to finance or offset high debt costs as well. Because now you can finance debt at, what is it, LIBOR +2 sometimes.
It's small.
Right?
Yes.
So I'm just also just making sure that I'm not missing any of the questions. And I think we got it all covered in terms of McEwen Mining. I just want to give you, because I cut you off like the last 30, 60 seconds to sort of talk about catalysts for McEwen Mining, what's coming up, what can we look forward to?
Well, one is our copper project. We did a PEA on it back in 2017. It's quite robust at $3 copper, so copper at $3.12. It's looking interesting. I'd like to try to put it into a gold perspective, a gold equivalent for investors, to get a sense of magnitude. So it indicated, inferred, if I converted the copper and the silver into gold equivalent, and there's gold there, the indicated resource would be 17 million ounces gold equivalent. The inferred would be an additional 37 million ounces gold equivalent. It's modeled to produce 415 million pounds of copper a year, at $1.14 a pound. If you converted using current metal prices, that to a gold equivalent and included the gold and silver credits, is about 800,000 ounces a year equivalent at $800 an ounce. And it would be it has a 36-year life.
Did you say 800,000 ounces?
Yes. Equivalency.
Yeah. But that's try to find something comparable in the gold space.
Yeah.
So
the capex is $2.4 billion, but at $3 copper, it's modeled to pay back in under 4 years.
Starting to slowly get realistic, yeah. And we've been hearing the presentations about higher capex projects becoming more attractive because of the higher gold and higher copper prices in the future as well. So, and companies like Barrick are looking for sort of projects like that as well, I'm sure. So
we're looking to spin it out into a separate company that's pure copper and add another copper porphyry project we have in Nevada, and because we're not getting value in our company, but we'd retain a large interest and have a mark-to-market value for our balance sheet and be able to fund it separately.
Fantastic. Okay, that's an interesting tidbit. I wasn't aware of the spin-out story, so that should add a little more excitement to the story as well, and to make it really interesting. Rob, I really appreciate you coming on the show. You were our closing keynote speaker. We've had 2 days of fantastic presentations, and I'm honored that you came on. And as I promised you, I'll get you on one of my shows, and I did. So I appreciate it. Thank you so much. And actually, one last question: where are you right now? You're in Toronto, I'm assuming.
In my office.
Yeah, we had one question coming in, wondering where you were. So